Podcast is now starting. All attendees are in listen-only mode.
Hello and welcome to James Cooper Creston's webinar on IFRS 16, the new accounting standard for leases. I'm Alan Poole, with me is Catherine Wilkes, and we're going to take you through an overview of IFRS 16 and hopefully teach you what you need to know. Feel free to ask any questions as we go. Time permitting, there'll also be an opportunity for questions at the end, and we will pick up and answer those that we can. So here is an overview of what we plan to cover today. So we're going to outline, well, of course, what is IFRS 16, give an overview of how to account for leases under IFRS 16, perhaps the interesting bit for finance directors, what impact will this have on the results, on the profit and loss and the balance sheet, the transitional arrangements, which are quite complex, the disclosure requirements. As ever, IFRS standards have detailed and lengthy disclosure requirements which have to be complied with. And we're going to try to pick up some of the specific challenges that we think the new standard presents for those companies who adopt it. At this point, also just mention we are really only going to cover this from a lessee perspective, not really from lessors, because that's going to be relevant to many more viewers. So, what is IFRS 16? It is the new international standard for leases. It's applicable to every company who prepares accounts under IFRS. The flip side of that, of course, is it does not apply to companies that prepare under UK GAAP, although I would probably add for now as a rider to that, because as many will know, UK GAAP is slowly moving towards IFRS principles, so there's every chance that the principles of this IFRS will fall into UK GAAP in due course. So if you're not yet reporting under IFRS, or indeed don't ever plan to report under IFRS, this may not be relevant to you right now, but there's a good chance it will be relevant to you in the future. So IFRS 16 replaces all the existing international rules for leases. It does apply to both lessees and lessors, although, as I said at the outset, we're only going to focus on lessee accounting here because that's more relevant for most. The stated objective that the standard set has said, fairly sensible stuff, to provide relevant information that faithfully presents lease transactions and to provide a basis for users of the financial statements to understand what's going on, essentially, and how those leases affect companies' performance, cash flows, etc. And the key point, really, if you remember one thing from this webinar and one thing only, remember that every lease comes onto the balance sheet under IFRS 16. You'll be familiar at the moment that leases typically fall into operating leases or finance leases. Operating leases generally off the balance sheet, finance leases generally on the balance sheet. Under IFRS 16, all leases come onto the balance sheet, and that really is the key message for today. So what lease transactions does IFRS 16 cover? Essentially all of them. There are a few exemptions which we'll just trip through very quickly in a minute, but essentially all leases are covered. And as I said earlier, both operating and finance leases fall in. In effect, the distinction between operating leases and finance leases is no longer relevant. There are a few exceptions, essentially for very short leases, and that means a lease of less than a year. Or for very low value items, so things like laptops, tablets, desks, things like that. One might not adopt the IFRS because it's just not worth the effort. And in those cases, you can just continue to expense the cost as a rental, straight line through the P&L, or if there's a more appropriate method, then follow that. But essentially, just those rental costs would just go through the P&L as before. There are some other very specific types of leases that are not covered by IFRS 16, and that's essentially just because there are more specific guidance already in place for those very specific types of lease transactions. But essentially for everything else, so property, cars, photocopiers, all the usual sorts of things that you lease through your businesses, it does apply to those, and it's particularly pertinent to property leases, as we will learn. When do the new rules apply? Well, the short version is now. So if you're a December year end under IFRS, December 19 is your adoption year, so that's right round the corner. If you're not December year end, then it's even earlier. So the short answer is now. I shall hand over to Catherine, who will take through how to apply it.
So how do I apply IFRS 16? I'm going to take you through what to recognise in your accounts. So there you are, a new lease in hand on the 1st of January 2019. What happens next? Well, there are two initial amounts you need to include in your accounts. The first one is the right of use asset, and the second one is the lease liability. Let's look at how these are calculated individually. So how do I calculate my right of use asset? Well, this is essentially the cost of the asset using a cost model. To calculate the cost, you take the initial measurement of the lease liability, which we shall talk through shortly. You will also need to add any payments made prior to the commencement of the lease and deduct any lease incentives received and add any initial costs or estimated future restoration costs of any sites. So let's look at the lease liability now. So to calculate the lease liability, you will need to take the present value of all future lease payments. The future lease payments include all fixed and variable elements, any residual value guarantees, and also any payments due on exercise of any purchase options. So basically anything you will be paying over to your lessor. To calculate the present value, you'll need to use a discount rate. There are some options here. You can either use the implicit rate of interest within the lease, or if one is not included in your lease documentation, the company's incremental borrowing rate.
Okay, so that's how we get the initial amounts onto the balance sheet, and hopefully what you'll have picked up from that is that we're going to have a very large asset and a very large liability coming onto the balance sheet, essentially finance lease accounting as we used to know it. And the really key point to note here is that if you're renting a property, say on a 10-year lease, previously that would have just gone through as a rental P&L transaction. But now the whole of the future rentals, 10 years worth, potentially millions and millions of pounds, if you've got a large property or a portfolio of properties, all of those future rentals coming onto the balance sheet essentially as a fixed asset and as a liability. So a huge impact. So then what do we do after we've done the initial accounting? So as time goes on, we're going to add interest to our lease liability, effectively unwinding the discounting. So the lease liability, as Catherine mentioned, goes on at the present value, but then that will increase over time as the interest gets charged, and of course offsetting that, the cash, the payments come off the balance, much like a finance lease under the old and existing rules. And then this new asset that we call a right of use asset, essentially recognising that I don't own this property, so to call it a property on my balance sheet would not be correct. But I have the right to use the asset over a potentially quite long period, so that is of value, and that asset goes on the balance sheet and is depreciated over the lease term, usually on a straight line basis. There could be a more appropriate basis, but it will typically be on a straight line. So what impact does this have? I'll say it once more because it's really important. The right of use asset, so the value of the future leases coming onto the balance sheet as an asset, and the whole of the future rentals as a liability. We're very used to this on finance leases, but on a property lease, we would never have had these imbalances on the balance sheet. So this is a really quite a fundamental change. On the P&L, so what used to be rental payments or lease payment, I'm using rental sort of in the context of property, but it could be a car lease, it could be photocopiers, servers, whatever. Those rental payments would have just gone through the P&L as as a rental lease cost previously, but now effectively we have a depreciation charge and interest charge. So we're going to ask you to give us your views from the first poll question. From what you've learned so far, how do you think this change will impact profits? If, for example, if you've got property leases that are currently going through as operating leases, they're now going to come onto the balance sheet, depreciation and interest. What impact do you think this will have on your profits? So the options are positive impact, negative impact, no change, or don't know. We'll just give you a few seconds to let us know what you think, and then we'll briefly chat through what you said. Okay, so that's the vast majority have now voted. Thank you, and there's quite a split really. Broadly speaking, a third of you think positive impact, a third of you think a negative impact, and a third of you think it'll have no impact. There's a slight preference towards a positive impact on the P&L, but essentially you're fairly evenly split across the three. Okay, so let's see what will actually happen. And we'll do that through a worked example of a property lease. So company A, your business leases a property for 5 years. We'll keep this really simple. There's no lease premiums, no incentives or rent free, anything like that. Just a really simple 5-year lease at a rental cost of £20,000 per year. You can see on the screen there under IAS 17 or under UK GAAP, under how we all sort of think about how we typically account for property leases. That would be a simple £20,000 per year cost to the P&L. However, under IFRS 16 is going to be quite different. We're going to create a right of use asset for the future payments. That's going to be 100,000, 5 times 20, so that's your fixed asset at the beginning. The liability based on a 5% discount rate comes out at 86,000 or thereabouts. So the initial liability will be 86, and the difference effectively between the two is the interest over the year. So we're going to depreciate the right of use asset. Both at the start the fixed asset and the liability both be 86,000, and then the liability will uplift to 100 as the interest kicks in over the year, over the 5 years. So how will that look across the P&L? You can see at the top there the existing P&L charge of a straight 20,000 per year. Under IFRS 16, you can see here that actually we have the same charge over the 5 years, which is probably what those of you who said no change were thinking about in the poll. But you can see here that the interest charge will actually be higher in the early years and lower in the later years. We're assuming here that depreciation is straight line. I think for a property that will typically be the right approach. But the interest will indeed reduce over time because, of course, the amount, the future payments, and therefore the liability is lower towards the end. So there's a smaller debt outstanding, and therefore a smaller interest charge, effectively front loading the cost. So in terms of the correct answer to the poll, in the early years it will have a negative impact on profits, later years a positive impact, and overall no impact. Back to Catherine.
So how do the transitional rules apply? So far we've just covered what happens at the inception of a lease under IFRS 16. But what happens if you have leases that are part way through their term when IFRS 16 applies? IFRS 16 helpfully provides some transitional options. And these options are the full retrospective application and also the modified retrospective application. Now, once you've chosen which transition option you are going to take, you have to apply it across all leases. So I'm afraid there's no cherry picking on the various leases. So let's dive into the detail of the two options. Firstly, the full retrospective application is absolutely just that. So you go back to the very beginning of the lease and account for it as if IFRS 16 had always been in existence by calculating your right of use asset and your lease liability at inception, and then essentially you roll it forward to the accounting periods shown in the accounts. The prior year comparatives will require a statement following this approach, and there will also be an adjustment to the P&L reserve at the beginning of the earliest period presented. As you can imagine, this method will require extensive historical information about the leases back to their inception, and if you've held leases for a long time, that will require quite a bit of digging. However, the restatement of the prior year means that you will have the two periods presented in your accounts on a like-for-like basis. The other option is the modified retrospective application. This method looks at the position at the transition date, which is the 1st of January 2019, as mentioned by Alan a few slides back. At this transition date, the right of use asset and the lease liability are calculated, and it essentially looks forward from that point. So, the right of use asset is your lease liability or a discounted amount, carrying amount, as if IFRS 16 had always been applied. So IFRS 16 gives you another option, and then your lease liability, similar to before, so your present value, but this time of your remaining lease payments. The modified retrospective method does not require any restatement of the comparatives, which does mean that the 2 years presented are not on a comparable basis. So, before we jump into the poll question, transitioning to the new leases standard can be a major undertaking, particularly if you have a lot of leases. Transition options are a major consideration for a business, and the choice you make on transition will impact your financial statements until the last lease in existence at transition expires. So a lot of businesses have fairly long buildings leases for some pretty hefty amounts, so the decision on which transition method to use should not be taken lightly. So where to begin? We recommend you prepare an inventory of all your lease data, model your transition options, understand what is important to your stakeholders, and then see how the different transition options would impact these metrics. So jumping into the poll question, which application are you likely to choose on transition? Okay, if we can close the poll there. Thank you for your responses, and we can see that most people would choose the modified retrospective application, and so compromising with the lack of comparability, but taking a far simpler approach. So we're now going to look at the disclosure requirements of the new standard. With any new accounting standard comes additional disclosure. These are detailed in the standard, and I'll just give you a quick flavour for how extensive they are. You will need to disclose the right of use depreciation charge, lease liability interest, an expense related to leases accounted for on the old basis, if you have any that you are not applying IFRS 16 to, any variable expenses not included in the lease liability, any income from subletting these assets. And there's more, your total cash outflow for leases, your additions to right of use assets within your fixed asset note, any gains and losses from sale and leaseback transactions, and the amount of your right of use, carrying amount of your right of use asset at the end of the reporting period. A lot of these will be included within your existing notes, such as your fixed asset note, your note about the amounts recognised in the profit and loss account, the interest note, and also your cash flow note. It's important to note that within your fixed asset note, your right of use assets need to be disclosed separately in a separate column. So a bit of other disclosure that you will need also is some statements about if you are adopting the standard early, which transitional provisions you are applying, and also that you are changing your accounting policy. Also, if you apply the full retrospective method, you also need to restate your comparatives, so you will need a restatement note as well. Okay, so now we're going to talk through some of the challenges that we foresee this standard will present. The first one is about the rent-free. You might have a rent-free incentive, and you might be carrying a liability in your balance sheet. How you unwind this, or how you deal with this. IFRS 16 doesn't really address this, and we are expecting something to come to light in the next annual improvement cycle. But essentially, our view is that you would unwind your creditor on application of the new standard and just look at what payments you would need to make going forwards. The second challenge we foresee is that you might be paying your rentals on a quarterly basis. So when you're looking at your lease liability at the date of application, you may wonder what to do with any prepayment. And again, we think that you should just be looking forwards and looking at the payments that you will be making at that point in the future.
Okay, so Catherine's there picked up on a couple of very specific challenges. We think there are also some slightly more pervasive and broad challenges thrown out by this. We've talked before that this is likely to have a slight negative impact on profits in the short term, but it's going to have much bigger impacts on measures that are commonly used in the market, like EBIT and EBITDA, because we now have an interest charge coming out of property leases, for example, that never would previously have had an interest charge. So effectively some of the rental cost now goes below the line, below EBIT, because it's interest, and almost indeed all of the cost of property rentals will now fall below EBITDA, because the costs are going to be depreciation and interest rather than rent. So I think in the long term, companies reporting under IFRS EBITDA is just a fundamentally changed measure. And those that have a lot of property will have a very different metric at that level to what they've seen previously, and also EBITDA will become much less of an indicator of cash. I think typically we'll be familiar that users of the account see EBITDA as effectively a good estimator of cash flow. That's clearly not the case if all your property costs are now falling below the line. Another one to mention is the impact on covenants. Essentially, this is bringing a load of debt onto the balance sheet that wasn't debt before, those future rental payments. So any covenants that are based on debt cover or even net assets, equity to debt ratios, all those sorts of things hugely impacted, and frankly probably will need to be renegotiated. Catherine mentioned lack of comparability. So where you do the modified approach to transition, you're going to lose comparability year on year in terms of P&L. And I think this where companies reporting under IFRS and those that don't, a big loss of comparability in terms of their results, their debt, EBITDA, all those sorts of things that we talked about. So plenty to think about, and probably the main point to take away is the debt going onto the balance sheet that wasn't there before. We've had a couple of questions in. If anyone has any more questions, we've got about 5 minutes left. Please do fire them in. I'll cover the simple question first, which is somebody's asked, will we get a copy of the presentation? So the answer to that is quite simple, yes. If you visit our website later today or after that, the slides will be up on the website, and so will this recording.
Yeah, and we've had another question about the full retrospective method. Someone has had changes to their lease in the past. Which version of the lease should be used? In this case, what you'll need to do is go back and apply the changes of every lease to your calculations. So as you can imagine, that's quite a big exercise if you've had a lot of modifications.
So we'll just give a few seconds to see if any final questions come in. If not, we thank you for your attendance and your attention. As we said, the recording and the slides will be on the website. If you have any further questions, please contact us directly, and we'd be delighted to help. Thank you.